The topic for today is stock valuation methods. At school level, we covered 3 different methods of valuing our stock: specific identification method, FIFO, and weighted average. With specific identification method, this is the most accurate method of valuing both your cost of sales as well as your closing stock. And the reason for this is because when you purchase stock, you can record that stock in a stock register with the exact cost price indicated. Then when you sell that stock, you go to the stock register and you take the cost price of the item you're selling from the stock register and record it as cost of sales. Likewise, at the end of the year, you take the cost price of all of your unsold items. You go back to the stock register and you obtain the cost price of each item that you haven't sold, add them together, and that will give you an exact closing stock figure. So this is a very accurate system or method. The problem though is you have to be able to identify each individual item's cost price, and that isn't the case for most businesses. They sell a wide variety and high volumes of different products. So therefore we need other methods of valuing our stock. The next one here is called FIFO. FIFO stands for first in, first out, which means you assume that the stock you bought first is going to be sold first. So when you're working out the value of your closing stock, you're going to look at your most recent purchases and use that value. So you take the number of units times the cost price of the most recent purchases, and you work from the bottom upwards until you get to the required number of units. Weighted average. Okay, there we work out a weighted average price for the stock. Okay, and you take that by working out your amount that you spent with your opening stock, etc., divided by your number of units that you purchased, and that will give you a weighted average price. You then use that weighted average to work out the value of your closing stock. And this method is used when it's not possible to calculate the exact value of each item sold, as in the same way nor the value of closing stock. So in other words, we're just going to use an average price here to value our closing stock. Right, some important calculations here. Frequently you get asked to calculate cost of sales. If you are asked to calculate cost of sales, you start with your opening stock, you add what you've purchased. Don't forget to add carriage inwards. That increases the cost price of your stock purchased. And also don't forget to subtract any stock that you've returned. From that you're going to subtract your closing stock value, and that will give you a cost of sales. Quite often they don't give you this closing stock figure. If that is the case, you're going to have to calculate your number of units in closing stock. So you start with your number of units in opening stock, you add the number of units purchased, you subtract the number of units returned, and you subtract the number of units sold. And that will give you your number of units on hand, which you then use, depending whether you're using weighted average or FIFO, to value this closing stock. The other thing you need to be able to calculate is gross profit. You should by now know this calculation, simply sales minus cost of sales. Sometimes they ask you to calculate the markup percentage achieved. The markup percentage is your gross profit divided by cost of sales, and because we want a percentage, we times by 100. You're going to use whatever markup percentage you achieve and compare that to your intended markup. In that way you can see whether you've achieved your intended markup or not. Alright, let's go through a worked example now. They tell you here that the business sells microwave ovens. The perpetual stock systems in use. In other words, you keep a continuous record of the stock on hand, and they use the weighted average stock valuation method. They then give you quite a bit of information. We're going to go though to the questions, because that will help us go to the necessary information above. The first thing they ask you to calculate is the number of units of microwave ovens that have been stolen. To work out if any items have been stolen, you first of all need to work out how many items you should have on hand. So if you look at the information here, we started with 100. We're going to add the number of units we purchased, 1150. They tell you that you return 10 microwaves, so you're going to subtract the number of units that you returned, and then you work out the number of units sold by dividing your sales by your selling price per unit, and that comes to 1110. That means we're supposed to have 130 units on hand, but they tell you over here that you've only got 115, which means 15 have been stolen. Then they ask for 2 internal control measures, excuse me, apart from security cameras or guards, which could be used to prevent theft from occurring in the future. Okay, the one thing you need to do is you need to check the number of items delivered. So when the stock is delivered, you count the number of items and compare it to your delivery note and make sure it's the same. You could do regular stock taking to identify theft as soon as possible, and any stock that you do have on hand, in other words your unsold stock, you could lock that away, keep it locked away in a secure storeroom. Right, then using the weighted average method, calculate the value of closing stock. The first thing we need to do here is we need to work out the weighted average price. So to do that, we say the opening stock value plus the purchases for May, the purchases for November, and the purchase of January. So those are the next numbers I add in here, and below that I put the number of units. So I said I had 100, that was for the opening stock. Your 3 things purchased came to 1,150. Then they told you, remember, that you returned 10. So you must minus 10. The amount you minus here, you look at the cost price of the January purchases, because that's the ones you're returning. They must be 700 Rand each. Okay, so you take 700 Rand for each item that you're returning. Okay, and then if you look here, it says carriage on purchase during the year was charged at 25 Rand, and then they tell you over here that we received the full refund including the carriage. So in other words, you're going to take the 7,000 plus the 250. That's 10 microwaves, that's 700 Rand each, 25 Rand for 10 microwaves, so you times 25 by 10. Then this 28750 here is your carriage on purchases. So you take the number of units you've purchased here, 1150, and you multiply by 25, and that gives you your 28750. You then calculate that, comes to 631 Rand and a few cents, round off to the nearest Rand there. You are told at the top here that you've got 150 microwave ovens on hand, so you multiply the closing stock, the average price by the number of units closing stock, and that gives you your closing stock value. Then when you calculate your cost of sales, you take your opening stock. Now I've added the 3 lots of purchases together here to save time. I added my carriage on purchases, and I minus the number of units returned, and I minused the closing stock figure, which I worked out at the top here, and that gives me cost of sales. It's important that you get this figure right. However, bear in mind that if you do make a mistake up here, you'll lose the marks in this question. But from then on, every time you use that closing stock figure correctly, you will get full method marks. So it's important that if you've forgotten how to do this, you make up something and then use that in your other calculations to get method marks. Right, then for the markup percentage achieved, we take our sales minus the cost of sales here over the cost of sales gives you 71.2%. You were given that sales figure. Alright, then the intended markup is 70%. So can you see we've exceeded our intended markup here? That's not usually the case, but can happen. And they ask for one reason. I put 2 down here. You could have made errors in calculations or marking of stock. So you marked the stock incorrectly, or you calculated the selling price incorrectly, or whatever. And then this is another common thing that businesses do. They sell old stock at new high prices. In other words, they might still have some of the cheaper stock on hand, and then they purchase more of the same item, and then when they sell the items, they sell them all for the same price, despite that the older stock was cheaper for them than the newer stock. So that's why they get a higher markup than what they intended to get. Then calculate the value of stock using the FIFO method. Remember, we had 115 units. Now, because we assume what we bought first, we've sold first rather, we're going to start at the bottom. Okay, so we're going to start with these 100 units. Don't forget though that 10 of those were returned. So you actually only have 90 of those units left, but we need 115. So we're going to have 90 of the units that cost 700 and then 25 of the units that cost 600. So if you go down here to the calculation now, you say you've got 100 minus the 10 gives you 700, and then 25 at 600 gives you 15,000. You add those two together, and then don't forget to add in your carriage here, which is your number of units that you've got on hand times the 25 Rand per unit, and that will give you 80875. So this is an important thing to focus on. Do not forget to subtract anything that was returned, and then the second thing, do not forget to add the carriage. Right, then the next one, the selling price remained constant despite the fact that unit cost changed during the year. Provide one possible reason. Okay, so overall the cost price went up, but we kept the selling price the same. Probably because we wanted to attract new customers, or we wanted to remain competitive in the marketplace. Then there was a significant increase in the number of microwave ovens purchased in November. Give 2 reasons. If you have a look here, okay, we bought 800 compared to 250. Well, one of the reasons because they decreased their price. Okay, so that's one reason it was cheaper. The other reason though is you're preparing for December, your festive season, because usually in December you're going to sell more. So those are the 2 reasons that I put here. To prepare for the festive season where sales usually increase and the unit price decreased to 600. Tabulate the main characteristic of your perpetual and periodic. With the perpetual, trading stock account is updated continuously, and because of that you know how much stock you should have on hand. When you then count the stock, you can see whether you've got more or less stock than you should have, so there's better internal control, because you're going to be able to determine if you have a deficit of stock. The periodic, on the other hand, the only way you can work out cost of sales is to do stock taking first. So you don't keep a continuous record of stock on hand. Because you don't know how much you should have, you can't work out if you've got a deficit. But it's a much more simple and cost-effective method to implement here. So depending on the type of product sold, you're going to choose between perpetual and periodic. Perpetual, basically, it must be possible to determine the cost price of individual items sold. Periodic, it must not be possible to determine the cost price of each individual item sold. Right, then the owner realizes the importance of having correct number of microwave ovens in his store. 2 problems if he's got too many microwave. Hey, the stock could become obsolete. Obsolete is just another word for saying out of date. It also costs money to store the unsold microwaves as well. Rental costs are high, so if you're storing a whole lot of microwave ovens, you're going to be paying more rent than you would have to if you had less microwaves on hand. could have bought smaller premises, for example. And the stock could become shop soiled. Okay, customers look at them, they move them, they touch things, they actually become a little bit dirty, shop soiled, damaged maybe as well. Then one problem of having too few microwave ovens, there you can't meet customer demand. There's nothing more frustrating for a customer to go to a particular shop to want to purchase something and find that that supply is out of stock. Then they're going to go elsewhere and probably not come back to your business anyway. So you must be able to meet customer demand at all times. And then the last question here, in your opinion, what would an ideal stock turnover rate be? Okay, you can put anything here as long as you justify your answer. What I said, around about twice a year, because stock's not going to become out of date in 6 months. And also, if we've got 6 months worth of stock on hand, we can have a different variety of different microwave ovens, different makes, etc., to give our customers choice. Alright then, so that's your stock valuation methods.